Good morning. My name is Haley Trefen, and I am a public library consultant here at the Indiana State Library. I'd like to welcome you to the 2020 Budget Workshop for Public Libraries. Thank you for your flexibility today, especially those of you who were originally signed up for the in-person workshop. This morning we are going to start off with Judy Robertson, Budget Field Representative for the Department of Local Government Finance. Judy, it is all yours.
Hello. If you have questions during any time of this presentation, please put them in the chat pod and I will try to keep an eye out for that. Today we are going to be talking about the new Form 4B.
I think you must have muted yourself again, Judy.
How did I do that? Okay, got it. Can you hear me again?
Yep, I can hear you.
Okay, great. This presentation today is specifically designed to discuss the new Form 4B layout, the new look. It is going to revolve around the purpose of the form, introducing the new layout, and to touch on some best practices in completing the form. And the first item we're going to discuss is the purpose of the Form 4B. And here is a flow chart that one of our employees has created that summarizes the budgeting process. Budgeting is an ongoing process. Even after a budget is approved, it needs to be monitored closely. In any budgeting process, best practice recommends that we start with the revenues, then move to the expenses to calculate our bottom line. In the government time frame, we have what's called the inputs. It's where we input everything that we know or want to request. Then we go to the heart of the budget process, which is the Form 4B. That's where everything comes together. And then from there, we can do our outputs, which is the Form 3 and the Form 4. Here's a detailed flow chart. The items up on top that are in Form 1 is what we call the inputs. It's your current year financial worksheet, your debt worksheet, your Form 1, and your Form 2. All those pull down into the middle or the heart of the process, which is your Form 4B. That's where everything is brought together to show your financial status. Then the two items in green on the bottom is called our outputs. The Form 3 is where you inform your taxpayers. Your Form 4 is where your fiscal body adopts your budget that has been presented. This flow chart includes all of the budget forms. If you follow this flow chart step by step, then at the end, everything should flow together in a smooth and timely manner. Since the budget process is based on an 18-month calendar, we first start with the current year, which is the last 6 months of the current year, and then we move on to the information needed for the upcoming or ensuing year's budget. The purpose for this presentation is to discuss the changes to the Form 4B only. I will not be discussing the other forms today in this webinar. The current format of the Form 4B is broken down by budget type, either an appropriation, a revenue, or property taxes. And it is not in chronological order, nor is it arranged by revenue first. It is currently required funds, funds on hand, and then property and local income taxes if your county has adopted it. Here is a snapshot of the current Form 4B layout. This is the format you are used to seeing, and there in red is the source material that pulls in from the other forms into the Form 4B. The first section is the expenses for 18 months, beginning in July 1st of this current year, running through December 31st of next year in this current budget process. The middle or second section is the cash and miscellaneous revenue available for 18 months. The bottom section, or section 3, is where you add your property taxes and calculate the rate based on the net assessed value you are using. This is also what we currently call line 11 is your operating balance. This is the estimated cash balance that you will have at the end of the ensuing year that you'll have to carry over to the next fiscal year. So if you're looking at your current Form 4B, the one that's been approved and certified, it starts on July 1st of 19 and runs through December 31st of 2020. The budget process that we are starting now will begin July 1st of 2020 and run through December 31st of 2021. So let's compare this to how you would do a home budget. Most of us would create a spreadsheet listing our monthly revenue, what's our salary, what's any other source of income that we have coming in. Then would we create a spreadsheet for monthly expenses. The difference between those two amounts is what we have as discretionary funds or surplus funds. If that is a negative number, then we may have to reduce our monthly expenses or take a second job to make ends meet. But in governmental accounting, you cannot take a second job. So if your bottom line is a negative, then you will need to work on your expenses. It is very hard to create new revenue streams in government. A representation of the Form 4B is sent along with your 1782 notice. That report is called the fund report, but it is your Form 4B. For those of you who are new to governmental accounting, 1782 notice is the notice that you receive after your field rep has preliminary worked your budget. The notice is sent to you and you have 10 days to respond with any changes. At the end of the 1782 notice period, then we will certify your budget. Any questions up to this point? I'm not seeing any. So what about the new Form 4B? What do we need to know about it? As you are probably aware, budgeting requirements change from year to year. Trying to keep up with legislative changes and keeping the same format year after year doesn't work too well. This has been a problem for the DLGF for several years now, and it has past time to recreate the Form 4B so it can be maintained and yet reflect all the information we are used to seeing, plus be adaptable to legislative changes. The most notable change is that the form is presented in chronological order, not by budget type, i.e., appropriations first, expenses second. The tax caps are going to be reported on the new Form 4B as a reduction to property taxes and not as an expense on Form 1. We're going to use the same source material. The same information is going to be reported, just in a different manner. We are going to create a revenue first approach for proactive budget. So the first lines you are going to see in each section is going to be based on revenue first. An overview is a new Form 4B will still have 3 distinct sections. It's going to have the current year, which would be June 1st through December 31st of the current year. Then we're going to do the upcoming budget year, which will be all of 2021. And then the last section is where you will put your data entry in necessary on this form and the tax rate calculation. And remember, the old Form 4B had 3 distinct sections also. But in order to compare apples to apples and oranges to oranges, you needed to know which line item matched in each section. And it was very difficult to get to your bottom line unless you knew how to work the form. The first 2 sections do not require manual input. They will all be pulled in from forms that you've already entered. The information for the last section will be manual. That is why we recommend completing the forms in order. All right, still not seeing any questions. Are there any questions out there over what I've done so far? Okay, let's go on to the current year section. This is the first section that you will see when you bring the new Form 4B up. It deals with the last 6 months of the current year. The line references you see in the parentheses ties back to where this information can be found on the old Form 4B. These are provided so that you can see the same information is being used, just presented differently. The first part is your available revenue. The second part totals expenses. And the bottom line is your estimated cash balance you will have at the end of this year. Moving to a revenue-based budget, you can see more clearly how your cash balance is changing while working through the form and how your cash is changing in a short period. You no longer have to wait for 18 months and then try to figure it out. The goal is to place templates on our website so that you can familiarize yourself with the new format and enter practice information. So let's take a close-up look at the top section, July to December 2020. You're going to report your cash balance and your property taxes to be collected, and we will discuss that a little bit more later in the presentation. So after available revenue is calculated, you subtract your expenses already incurred through the first 6 months, and then that will give you your total cash and revenues. The bottom part of the slide shows information on line 1 and 2 pulls directly from the current year financial worksheet. Once the information is entered in on that form, it pulls directly into this form. No additional data entry is needed. By entering the information in one form and pulling or copying it into another one, form cuts down tremendously on typos and getting information one line off. The lines 3 and 4 information is pulled in. So line 3 is pulled in line from the form 2, column A. And line 4 is simply a calculation. Going to lines 5, 6, and 7, one item to note is that we are expanding the outstanding loans line, previously the line 4A, to include transfers, either temporary or permanent. Line 7C is going to be reserved for schools and will be activated in a year or so. Currently, when you do a transfer to the rainy day fund, we have you put it there on the line for outstanding loans, simply because we did not have a separate line item. That is changing. We are going to make a place for transfers out and outstanding temporary loans. In the future, not this year, unfortunately, but in the future, 7A is going to be for transfers out, 7B will be for temporary loans. That may be reversed, I don't know, but we're going to separate transfers and outstanding temp loans. And then for schools, we're going to add another line for their transfers out to other funds. So again, all this information you will enter originally on the current year financial worksheet. Total expenses are calculated, and from there, the estimated cash balance is calculated. This is the cash you have to carry forward to help fund the 2021 budget. There are no source materials for lines 8 and 9 because they are simply calculations. So to recap the current year, if it's cash balance, you add revenues, subtract expenses, that's your estimated ending cash balance. If your ending cash balance is a negative, then you're going to be carrying forward unfunded expenses over into the 2021 budget. This is the result of either spending more than was approved and or revenue estimates were too high. It is a good time after you do the current year financial worksheet to look at your budget and to see how it compared to what you asked for and were approved to spend and the actual revenue coming in. You may need to take some adjustments to your budget at this time. If you determine that the revenue is not coming in as high and your budget is not going to be funded, you can consider doing a current year appropriation reduction resolution. That will reduce your approved appropriations, but it will free up some cash that could be carried forward. So in this example, how much did the unit reduce their cash balance between June 30th and December 31st? So on June 30th, the cash balance was $1.5 million. We go down to line 9, their estimated cash balance is now $1 million. So their cash changed by a total of $500,000. So we spent all the revenue that was listed on line 2. We used up all the property taxes collected on line 2 and used an additional $500,000 of cash on hand in order to fund the first 6 months budget. If this type of spending is occurring, you may be caught in a downward spiral until the point the DLGF can no longer approve your requested budget. If you detect this is a continuing trend, then you need to do some serious research on spending activity and take a closer look at line items and how your revenue are actually coming in. Okay. Again, I'm going to pause for a minute. I'm not seeing any questions. If we have no questions, if nothing's popping up, I'm going to go to the next section. This second section of the Form 4B follows the same flow as the first section, but this time it is for a full year. First, we account for all revenue available to fund the requested budget. Line 10 should be left blank. If a unit has levy excess, we, the DLGF, will populate the amount when we work your budget. Excuse me. How do you know if you have levy excess? Your DLGF field representative will notify you and give you further instructions. If you're not receiving a letter from the DLGF, then you can assume that there is no levy excess. Somebody out there is asking, well, what is levy excess? Levy excess is when you collect more property taxes than when you were certified to receive. So let's say the DLGF certified you will receive $100,000 in property tax. When everybody pays their bills, the auditor or the treasurer actually collects $110,000 in property taxes. Well, if that $10,000 additional is not because people are paying their taxes late from another year, and that's what we call levy excess. It's collecting more than what you were certified. And if that happens, again, your DLGF field rep should notify you with details on how to handle that. Here's another question I get quite often after year after year. Well, I have an amount in levy excess, but I don't know where it comes from or what I should do with it. If that's the case, contact your field rep and they may be able to help you track it down. But basically, your budget order will tell you when it's time to transfer that amount out of levy excess over into the general fund. So if you have your past budget orders, go through them, and under the general fund, it will say words something like that. You are now authorized per IC code 6 something 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 to transfer this amount from levy excess to fund the budget. So please be mindful that you need to look at your budget orders, if you have levy excess especially, to determine when to transfer the levy excess out. So let's go on to line 11. 11 is where property taxes are added. For a library, for the general fund, you will enter your max levy here. And again, your max levy will be given to you by the DLGF right around July 15th. If you don't see it come out, a memo coming out, contact your field rep. We will have them by the middle of July. As soon as we get the max levy growth, it's got a new name now, max levy growth quotient. And we should probably could help you at that time. But until we get that growth factor, I don't know what your max levy is for next year. Line 12 is where you will now report property tax caps, also known as circuit breaker. How we report the circuit breaker impact is a major change from how it's reported in previous years. It is no longer included as an expense on Form 1, but reported as a reduction to property taxes. And since it is a reduction, it's property taxes you're not going to collect, that should be entered as a negative amount. Lines 13 and 14, once miscellaneous revenue is added, we can calculate total revenue available. Again, this amount pulls directly from the Form 2, column B, and is not a manual entry. So again, this is for a full year. So on the Form 2, we're going to go to column B and not column A. The next section is where the budget request entered in the Form 1 will pull over as to your 2021 budget estimate. This is also where you're going to record any outstanding temp loans you have and any transfers that you entered on the current year financial worksheet. Okay, Melissa is asking, if the property tax cap is lower than projected, will we receive those funds? Short answer is yes. If we certify, and you'll see an example a little bit later I can use. So if we certify you with a levy of $100,000 and property tax caps are $10,000, so we expect you to receive $980,000. If when the tax bills go out and you receive more than that, then yes, that will add money to your cash on hand that can be used during the year via an additional appropriation. Or you can just leave it in your cash balance to be used in the future. But yes, you will receive those funds if property tax cap estimates are lower than actual. Lines 17 and 18, these next two lines totals expenses and calculates the operating balance. There is no source material because they are calculations. The bottom line is now the bottom line. It's your estimated cash balance on hand after all expenses have been paid. Two assumptions. Number one, you spend the full amount of the appropriations that have been approved, and revenue comes in 100% as estimated. If there are adjustments to any of those, then your cash balance is going to go up or down. How do we verify the tax cap amount for our unit? Will that come from the DLGF? Yes. The DLGF is the one that calculates your tax cap, and usually within I'm going to say 60 days of all budgets being certified, the abstracts is prepared, and we will put the circuit breaker report on our website. In fact, it's out there right now for 2020. You can go back and look at the estimated amount, pull up the report, go to county specific information, click on your county and scroll down, and you should find the circuit breaker report that will tell you your actual, which can be compared to your estimated. Again, if you have trouble finding the report, contact your field rep. We can point you to the correct area. So line 18, if this line is negative, then your budget is not funded and further adjustments will be needed. This can be done in two ways. Either one, you can reduce current year appropriations, or you can reduce your requested budget. Maybe you have some additional revenue that you forgot to put in that can be accounted for, but most of the time it's going to be either reducing current year appropriations or reducing your requested budget. Is line 12 our figure or yours? Let me see. Property tax cap impact. Okay, good questions, John. By statute, we are required to give you estimated property tax caps. You do not have to use the DLGF's number. You can adjust it. But I've got a caveat on that. If your adjustment or if your estimate is lower than ours and you're way off, then your budget could not be funded. So, but if you think you have a better, no, let me rephrase that. If your estimates are more closer to what you think they are than ours, then yes, please use yours. Any more questions on property tax caps before I go on? Yeah. The last section of the new Form 4B is the section where you will enter the net assessed value and the tax rate is calculated. These two lines do not pull in from another form. You will actually have to manually enter these two lines. For the net assessed value, best practices says that you need to use 85 to 90% of your current net assessed value in order to protect the rate. Well, what do I mean by protecting the rate? When we go to certify your budget and we approve the levy or the rate, we will approve the lesser of. So let's say you've used a levy, you want $100,000 in levy, and you're using a rate of 0.10 cents. And I'm doing this in my head, so the math may not work out correctly. If when your certified net assessed values come in and we go to work your budget, and that rate of 10 cents now brings in or generates $900,000 of levy instead of $100,000, then we're going to use the lesser of the rate of 10 cents, and now your levy is $900,000 instead of $100,000. So we want to protect that rate, drive that rate up higher so that you can guarantee or not guarantee, but that you're getting the full max levy you're allowed. So if you use a levy of $100,000 and lower your net assessed value, that may drive your rate up to 13 or 14. But that's okay, because this is estimated only when we the DLGF certifies your budget and we use a certified net assessed value. If your assessed value is increasing and not decreasing, then that rate will come back down. It's an inverse relationship. Let me explain it in another way. You have attended a meeting, and there were 20 people invited, and 20 people showed up. Well, one person in that group decided to stop by the grocery store that morning, has brought in some fruits and some bagels and muffins, things for you to snack on during the meeting. She brings in a pretty good spread, and everybody decides to chip in. So she tells everybody that she spent $20 on buying the food. There's 20 people present, so that means that if everybody chips in $1, then the host will only have spent $1 of her own money. Okay, let's go to another scenario. Another meeting is held, and the same person brings in a nice spread for breakfast again. But this time, only 10 people attend. Again, the cost is $20. So to help her not spend all of her money, everybody now must chip in $2 instead of $1 to help cover the cost of the food. So the more assessed value you have, the less your individual rate is. I'm hoping that you can understand that. Unfortunately, in this format, I can't look at your faces and see the blank looks or see if I need to expound more. But we want to drive that net assessed value lower to increase the rate to protect it. Now I'm hungry for muffins and bagels. Sorry. Can't help you there. Okay. So I hope I was able to clear that up a little bit. So here's the budget year summary. The same three factors are included. Your revenue minus expenses equals your total amount to carry forward to the next year. So revenue minus expenses for 12 months equals your estimated operating balance at the end of the ensuing year. All right, here's a good place to stop and pause a minute. Anybody else have any questions over what I've discussed so far? Okay. By the time you get to the Form 4B, most of the information has already been entered via the other forms. On this form, a non-school unit should only have to enter 3 pieces of information. Either the net assessed value, usually 85 to 90% of current. You will enter one of the methods, either levy, rate, or operating balance, and your estimated circuit breaker loss. You can use either the DLGF estimate or your own estimate, but everyone should be considering the impact. Okay, question. So keep the rate high so the net assessed value is lowered, right? Yes, that's another way to see it. Keep the rate high. But if you keep the rate high, you have to decrease that net assessed value, and then your levy is going to be protected in that case. So again, net assessed value, 85 to 90% of current. You're going to put your property tax levy in, your estimated circuit breaker losses. The net assessed value, it is rare for a unit to have this figure when they are working their budgets. Even if your auditor has certified the values by the time you work with your field rep, we still recommend using 85 to 90% of your current net assessed value in order to protect the rate. Reducing the net assessed value will increase the rate with the expectation that it will go down when we certify the budget, or based on the net assessed value increasing each year. So why is this important? Let me give you an example. About 3 years ago, in reviewing the certified net assessed value, it was determined that a county had failed to take out utilities and nonprofit values. And they had to go back and recertify the net assessed value. When they did that, the total net assessed value for the county decreased by 17%. When the field rep went to certify the budgets, he was having to use the rate, and a lot of people lost some of their levy because of that. That's why we say use 85 to 90% to protect yourself in case the auditor finds an error and has to recertify the values. Okay. Some of you are using 80% of the current year as an estimate, and that helps keep the rate high. That is fine. We recommend 85 to 90, but if you want to go greater than that, that is perfectly okay. Sometimes when I get working to unit and I find out, oh, we've had a couple of factories close down or something, and I will go back and recommend a lower, 80% or something myself. So just pick a number that you're used to, a percentage, and stick with it. Okay. So method selection. The gateway calculator, we use the assessed value, then there are 3 methods. You can see them listed there: the levy, the rate, or the operating balance. The levy method, you want to use this for any levy-driven funds, those that have a max levy, like your general fund. So if your max levy is $2.5 million, that's what you will need to choose as a levy method. The rate method, you will use this for a rate-driven fund. This is primarily for cumulative funds. Libraries no longer have a fund that is what we call rate driven. Those of you that have been doing finances for a library for some time will remember the old library capital projects plan. That was a rate driven fund that the DLG had to approve. And I don't even remember the year, but that was done away with and the amount folded into your general levy. I would not recommend that you use this levy unless your library that needs to keep your rate the same. You're interested in the rate, not the levy. The caveat to that is if you use a rate, you could be losing levy because it will draw in less than the maximum. So be very careful if you're a librarian and you're using the rate, because that could get you in trouble. The third method is the operating method. This method is used primarily for debt funds. Since the operating balance is restricted to either 15 or 50% based on when the debt was issued, then this method is best used to calculate a rate levy based on how much you are allowed to maintain as an operating balance. The data entry section, the bottom of the form summarizes this portion. It's your property tax levy, your net assessed value, and here's where the rate is calculated. The estimated tax cap loss is always entered as a negative amount. It is going to be reported as a reduction of property taxes and not on your Form 1 any longer. This next section, and the next line item is for schools only. Schools are allowed to transfer between funds. Here's where they will be reporting that transfer. Okay. Can you please say again why we should use the levy method? Sure. The levy method is for what's called levy-driven funds, those funds that have a maximum levy. For libraries, that is your general fund. So a levy is for any fund that is driven, that has a max levy attached to it. For libraries, that is your general fund. Your LRF fund can have no levy. It is funded by a transfer from the general fund. Same thing with your rainy day. So any fund that is bound by a maximum levy is when you should use the levy method. Okay, we are adding an extra line to the data section. So let's say you get to your board meeting and your board decides not to fund a project this year and they don't want it included in the budget. We are adding an option to override the budget estimate in case of emergencies or during a board meeting. You may need to reduce the requested budget, but do not have the time to go back into the Form 1, make the revisions, and carry those over into the Form 4 and print that out for adoption. This line can be used to reduce the budget as a whole to allow your board to adopt the revised amount. After the meeting, you will have time to go back into your Gateway account, revise the Form 1 and Form 4B, then submit the forms with the correct adopted amounts. And remember, you now have 5 business days to submit all your budget forms. So that's sufficient time after the board meeting to go back and update your forms if the board adopts something less. A recap. Most of the data for the Form 4B flows in from the other forms. If you're a non-school, you will be entering your net assessed value estimate, either the levy rate or operating balance, your estimated tax cap loss, and that will determine your bottom line, your cash balance available going forward. Okay, frequently asked questions. Lit levy freeze is missing from the new format. How do I report this? This used to be line 13B, right above, reported right above your property taxes. One change is that if you're levy freeze counting, there's only one or two of them that have not thawed so far. Then your lit levy freeze amount is now shown as revenue on the Form 2. You will no longer report it as a tax along with your property taxes. Line 7B and 16B say reserved. Why are they reserved? Okay, here is where we're going to eventually separate temp loans and permanent transfers. Permanent transfers would be transferring to the rainy day fund. We're going to separate that as an outstanding loan so that those two items can be separate because separate activities need to be done and associated with those activities. Still not seeing any questions, so I'm going to go on. What happens next? So this year, the DLGF is emphasizing the transition to the new layout of the Form 4B. We're going to continue communicating at the new layout up until budget season starts in August and September. We did have a webinar on this on March 18th. That webinar is now on our website. You can go to it, pull it down, review it, either the slides or as PDF. In April, the department had planned on releasing several things, but COVID-19 kind of threw us off balance, and we're not quite there yet. I looked this morning, I still didn't find it, but we are planning on putting a workbook and a blank 4B template that you can use for practice. So what happens then? So once those templates are available, units can begin to familiarize yourselves with the new template. Elected officials will be working with their budget field rep, either via email, cell phone. County visits are passed and most of them had to be canceled. And we will continue to release updated FAQs as more questions arise. Please contact us with any questions. If you do not know who your field rep is, you can find that information on our website. If you have questions and cannot get a hold of your field rep, please feel free to contact me. Again, my name is Judy Robertson. My number is 317-650-2508. Any other questions out there? You've been very quiet today. No other questions? Haley?
Yes, I am not. Please repeat your phone number.
Phone number again is 317-650-2508.
Okay. Thank you so much for sharing your wisdom and experience with us today, Judy. I
Still finished in
know
less
it
than an
is.
hour.
Yep. Even though it was didn't make it into the 2 hours, you will still get your 2 LEUs for today. So I am going to go ahead and put those in the window here. We're going to leave up that for about 15 minutes. So if you have time, go ahead and make sure you download that before you walk away from your computer. Um, so it is 11:21 our time here in Indy, and we are going to come back at 2 p.m. for the State Board of Accounts portion of the webinar. Um, and again, there is your LEU certificate to download, and we will see you at 2 p.m.